Good morning, everyone. We can have everyone take a seat kindly so we can get the morning program going. Right in. I learned that from the Business Council, which is appropriate because they have my former question this morning. All right, good morning. If you could all take a seat and we'll get our program going. I'm Johnny Evers, President and CEO of ACEC New York, and welcome to the first full day of the Winter 2023 Conference. We hope you all had a good chance last night to get a welcome and introduction to all your colleagues and friends. I'll go a little off script. Jan always gets nervous when I do this, but 450 plus here this year. I think that's the highest ever. So, following up that, we have a jam-packed schedule for today. But don't worry, we have a secret weapon to help you power through the day: coffee. Followed by tonight a little something stronger. So grab a cup by our exhibitors, follow the keynote, and let's get started. Today we have a full main track program featuring agency presenters and 3 parallel tracks for CFOs, emerging leaders, and HR professionals. As a reminder, main track attendees are welcome to attend any of the 3 track sessions. Our annual Infrastructure Policy Network reception will take place this evening in the room next door here in the Capitol Center, where there will be many opportunities to build connections with legislators and industry leaders. We'll be honoring our policymakers of the year, Assemblywoman Donna Lupardo, Senator Tim Kennedy, who were instrumental in passing our ESOP bill, and, this will be great, Governor Kathy Hochul. So everybody wear a tie tonight. We're gonna have the governor here. Before I introduce our keynote speaker for this morning, please join me in welcoming to the podium Heather Mulligan, I'm sorry, boss, President and CEO of the Business Council of New York State, the best boss I've ever had, and will officially kick off our conference. Heather?
Good morning. I'm pretty sure I wasn't Johnny's best boss ever. Dr. Evers. I just wanted to take a few minutes to say welcome. I am the head of the Business Council of New York State, which is the state chamber of commerce and the state manufacturing association. As Johnny mentioned, he worked for a period of time at the Business Council, and we miss him terribly. But certainly, if this crowd is any illustration, he is an incredibly effective and capable leader of an association. It's a really hard time to be running associations. I looked at your agenda, it's very robust. He's got leadership from the political class, which is good. And before you hear about the economy, I was just gonna take a few minutes to talk about the challenges I think that we're facing in the political realm. We had an election last year, if anyone wasn't paying attention. Unlike a lot of other states, we actually had very little change in the composition of our legislature, except for one thing. In our state Senate, the Senate Republicans did gain a seat, and the Democrats lost a seat, but the increase in the number of progressives in that conference has led to a very different political climate in terms of dealing with the business agenda. We're looking at a group that really would like to see very large increases in taxes, is overtly hostile to business. And this all comes at a time when I expect you're going to hear from your economists that we're in very fraught economic times. So it's really, really important that you engage with your association. ACEC is well respected and well known in Albany. And as far as how you do your business, the economy obviously matters. There has to be economic activity for people to want to build things, right? And so your advocacy here as an individual really counts, and the way that you do that is your voice is heard through associations like the Business Council, like ACEC, which I know is a very active member of the Business Council, and we will go lobby on your behalf to try and improve the business climate and stand up for your interests, because there are loud voices on the other side who will speak up against your interests. It's very challenging times, but I have to say I'm super impressed by the agenda, by what Johnny has laid out for you. I know it started last night, but today looks like an incredibly strong and informative day. And I welcome you all to Albany, and thank you for taking a few minutes to listen to me. Thank you.
Well, thank you, Heather. I'm going to stand by that. You were my best boss. This morning, we're pleased to have Thomas Riggs from PFK O'Connor Davies with us. Tom is the 16-year tax partner and managing director of tax strategic advisory for PKFOD. I get the right time, I'm sorry. He's an attorney as well as a CPA. Tom also heads up the firm's Policy and Procedures Committee, dealing with national issues affecting taxation, businesses, and investment. Today, Tom will talk about money, inflation, the Federal Reserve, and budget deficits. Kind of heavy stuff. And what it all means for the U.S. economy as we move forward into 2023. So please, help me welcoming Tom Riggs. Tom?
Testing 1, 2, 3. Morning, everyone. John, thanks for having me this morning. I was asked to speak about the economy and specifically where the economy is going this year. And frankly, no one knows for sure where the economy is going, but hopefully by the end of the session today, you will all have a better understanding of how some of the gears fit together and the machinery of money and the economy to be able to make your own decisions. At least that's my goal today. As John mentioned, we're going to talk about inflation, the money supply, Federal Reserve, fiscal policy, and how this is all going to come together, maybe on a collision course that you're immature yet, but we'll see as the economy progresses. I have to spend 60 seconds on my firm. I promise it won't be any more. We're a 132-year-old firm, mid-sized accounting and advisory, 1,500 professionals, 200 partners, of which I am one, 16 offices in New York City along the eastern seaboard, from Boston down to Palm Beach. We were founded in 1891, and we have 20-plus clients that have been with us over 70 years, so we've been around for quite a while. And it happens to be a really great place to work. We have one of the lowest employee turnover rates in the industry, 90% retention versus 81. We recently merged with DGC in Boston, one of the leading A&E firms in the country, and the merger of the two practices gives us a fairly robust situation with their industry. David Sullivan heads it up. So that probably wasn't even 60 seconds. The economic outlook for 23. It really depends on what is going to happen with inflation. That's the big wild card this year. They originally said, well, explain what's the economy going to look like. And as more and more I got into it, it all came back toward inflation. It seemed to be a problem we're going to have this year. There's currently no consensus among Wall Street firms, economists, what have you. Even the Federal Reserve, Jerome Powell heads it up. When they ask him what he's going to be doing this year, he basically says we're going to be data dependent. Data dependent is the Fed's way of saying they don't know what's going to happen. They're just going to read the tea leaves as they happen like everyone else. So they're also in the dark here. And why is that? That's because the current level of inflation has been exceeded only twice in the last 75 years. And unfortunately, both times those periods ended badly. Now, does that guarantee that this year is going to end badly? No, not at all. In fact, there's some counter issues this year that may help the economy out of this situation. But as of right now, if you look back over time, we're not really in a good spot. So just how big is the inflation problem? Well, it's big. It was basically 2% or under going into the pandemic. The consumer price index topped out at 9.1%, astounding number. If you said could the economy withstand that, absolutely not. The core CPI minus food and energy topped out at 7%, it's backed off at like 5.7. Still astounding numbers. There's been some moderation recently, but we don't have moderate inflation yet, that's for sure. And unfortunately, bringing down inflation is like going on a diet. The first pound or two was much easier than that last pound or two. So to get from 9 to 7 is much easier than to get from 4 to 2, the Fed's target rate. So right now, the trend is our friend, but we're not there yet. This is a chart. You've heard the phrase, off the charts. There's our inflation number on the right, way off the chart, in the upper right-hand corner. So that's what we're up against. Well, let's talk about some of the underlying machinery of the economy and what we think, how that's going to come together this way. First, let's talk about what causes inflation. There's a lot of definitions and a lot of explanations of what causes inflation. But Milton Friedman, who was an economics professor in the 70s at the University of Chicago, where I'm from, Chicago, that's my accent. Hard to figure out where I'm from. He had a very simple explanation for inflation. He said it's too much money chasing too few things. As simple as that. It's too much money chasing around, trying to buy things. Money is made up of cash and bank deposits. Things are basically the sum total of goods and services that we produce to buy. Gross domestic product plus imports. So you got money and you got things to buy with it. The US, by the way, has the highest GDP in the world at 21 million, next China 15 and Japan at 5. By the way, Russia has 1.9 trillion GDP, similar to Brazil or Italy. So they punch way above their weight because of the military. But from an economic standpoint, not much going on there. In a healthy economy, GDP and the money supply are in equilibrium. There's enough money for people to spend, and there's enough things for them to spend it on, but things don't get out of whack either way. And over the long term, the growth in money supply should roughly track the growth in GDP. They move in tandem. But every once in a while, things can get out of line. And that's where we are now. So right now we have money growing too fast. Let's talk about money and how it's created. And I think you'll understand a little bit about what the problem is now. Money is created by borrowing. Money is credit. Remember we said cash and bank deposits are money. What's in your banking, what's in your checking account, what's in your brokerage account, that's in cash. Borrowing is private sector and public sector. Public sector, so you, me, and the government, we all create money when we borrow something or buy something on credit. And I'll explain that now, how that works. In the case of private sector borrowing, money supply grows when consumers borrow to spend. Let's say you have $100,000 in the bank, and you want to buy a house for $500,000. Well, I only have $100,000. That's the money. So what do? I go to the bank, I borrow $400,000. The bank basically puts it in my checking account, and I write a check, or at the closing, I buy the house for $500,000. The bank and I have just created $400,000 that wasn't there before. That debt is the money, that credit is an increase the money supply by $400,000. The seller of the house takes $500,000 now and does something with it. He or she puts it in the bank, buys something else or whatever, and that money travels through the economy. So by borrowing and spending on credit, that really is the money supply, because that's the basis behind most bank deposits. Now typically, aggregate credit in the economy generally increases, as I said, with GDP. And I say that thankfully because what happens in the other direction? I'll talk very briefly about deflation and a shrinking money supply, which is when there's more credit being taken out of the economy than being brought into the economy. When you pay down your mortgage, if you sell your house, you take $400,000 out of the money supply. So, loose definitions. Deflation is falling prices throughout the entire economy. The whole price level sinks. Recession is 2 consecutive quarters of negative GDP. And depression, well, we all heard what that is. That's an extended period of GDP or a very severe depression. My favorite definition, or difference between a recession and a depression, is a recession, my neighbor's out of work, and depression is when I'm out of work. So it's just a matter of degree. Oh, I skipped ahead there. I want to talk a little bit about what happened in the 30s. Coming out of World War I, the Roaring 20s saw a lot of money creation, and a lot of that money found its way into the stock market and created this huge bubble in that asset class. To cool that frenzy, the Federal Reserve began raising interest rates to slow things down and cool it off. The tightening caused the stock market to crash in '29, with a 90% drop in stock prices, 30% unemployment, 28% unemployment, and money supply shrinkage by 30%. And it lasted on and off for the entire decade of the 30s. And the thing is that the specter of the 30s still haunts policymakers today. There's an inherent bias in keeping interest rates low to keep us away from that negative or that shrinkage in the economy. So there's a tendency for the Fed and for the government to want to create more money and spending all the time. Similar to when the private sector borrows money and creates money supply like we talked about, the government borrows as well. To understand how this works, let's talk about fiscal policy. Fiscal policy is basically what the government takes in as revenue and spends in the budget. The government spending is funded by two sources, taxes and borrowing. Just like an individual who earns their money and they want to buy something more, they got to borrow to spend it. But the deficit is when the government spends more than it takes in. Surplus is when the government takes in more than it spends. We don't have much of that going on. And balanced budget is when they're both equal. Currently, there's right now budget deficits as far as the eye can see. Projected deficit is over 1.3 trillion each year over the next 5 years. Incredible amount of spending. And over the last 50 years, there's been only one brief period when their budget surplus existed. It was way back in the Bill Clinton years, at the turn of the 2000th century. So the federal government is now in a state of perpetual budget deficit. And in fact, 2021, this is a scary statistic, first year since World War II that the government had to borrow more than 50% of what it spent. A trend that certainly cannot continue, and the trend is moving away from that again, but still, we're far from where we should be. So how do budget deficits contribute to inflation? How does government borrowing increase the money supply? Well, government bonds, which is how they borrow money, they issue a bond and someone buys it. They're sold at auctions. And every single bond that's ever offered at auction is always sold. You say, well, that's pretty amazing, right? Where's the none of buyers that want to buy? There's never an unsold bond at an auction. That's because a group of primary market dealers are obligated to bid and clear the inventory of bonds at every bond auction. Because the last thing the government wants to do is offer bonds and there's no buyers. There's not enough buyers. That would reverberate throughout the global economy. So all these dealers buy everything, no matter what. In turn, these dealers can take the U.S. bonds and resell them to retail customers throughout the globe, investment banks, hedge funds, whatever. So they make a little profit. They mark the bond up a little bit. But what happens when there's insufficient retail demand to clear all the bonds? Now the dealers have bought them. What do they do with them? They can't sell them all. But now we got to talk about the Federal Reserve, because this is where they come in. The Federal Reserve Bank was created in 1913 with two things that they had to do: maintain stable prices and full unemployment. Keep those two things in line. That's the mandate for the Federal Reserve. The Federal Reserve is headed up by Jerome Powell. It was originally designed to be independent from the government so that it kind of was off to the side and wasn't influenced by politics. But it turns out that it was an impossible task, and the Fed is now under constant pressure from Congress and the administration to stimulate the economy. No politician wants to preside over a recession, so there's always pressure on the Fed to keep rates low and keep the economy stimulated. What are stable prices? Well, in 2012, Fed Chairman Ben Bernanke announced that we want an inflation rate of 2% every year. We'll keep it at 2%. A little bit of inflation is good. Promotes growth, promotes investment. So they said 2% is probably a good compromise between 0 and something higher. And that's 2% the personal consumption index, which is not exactly consumer price index, but it's close. It usually tracks a little 1.25% lower. What is full employment? The Fed never said what full employment is. I will tell you my own experience, it's about 3.5%, which happens to be where we are now. That's called frictional unemployment. There's always some unemployment in the economy. You can't get rid of it. People quit their jobs, they start new careers, they take training, they take sabbatical. There's always some people not working, and that's believed to be around 3.5%. Full employment without really meaning it full employment. To meet their mandate, the Fed has two really powerful things they can do. First, they control the size of the money supply, and they must maintain a fair and orderly market for U.S. bonds through open market operations. I believe the Fed, and myself included, believe that the Fed is the most powerful institution in the United States because they control money, they control the economy. Let's talk about the first power. How do they control the money supply? Well, remember, we talked about the money supply is people borrowing. So how does the Fed control the money supply? They control interest rates, which is basically what the Fed can control is the Fed funds rate, which is the base rate that all rates flow from. That's right. If you look at the prime rate, you look at mortgage rates or whatever, everything is pegged to that basic rate of interest. If they lower rates make borrowing attractive, which increases credit, causes the money supply to expand, stimulates economic activity, and reduces unemployment. But you don't want to reduce it too much, right? Because if you make the economy too hot, if you heat it up too much, now you're looking at inflation. Higher interest rates, conversely, would be a situation where you make borrowing less attractive. As interest rates go up, mortgage rates are now at 6% plus. You probably look around this room, everyone who has a mortgage is probably down around 3%. So you're looking at rates go up and go, that's not really me. And that's something, there's a lot of truth to that. But higher rates make borrowing less attractive, less mortgages, less buying of houses, which causes the money supply to contract, to go down, which in turn restricts economic activity and reduces inflation. But you don't want to go too far because then you might increase unemployment and cause a recession. So there's this constant balancing that the Fed has to go through. The constant balancing, I call it the yin and yang monetary policy. The Fed has to keep unemployment down without triggering inflation, so they're constantly weighing these two things. Currently, we're experiencing a hot economy, high inflation. So the Fed's raising rates, credit is contracting, and the economy is cooled. Inflation is starting to come down. We don't know how fast it's going to come down yet, but it is moving in the right direction. During periods of high unemployment and sluggish economy, which we don't have, the Fed does the opposite. They lower rates, credit, money expands, people buy things, the economy grows, and unemployment comes down. In 2009, the Great Recession, the Fed lowered interest rates to zero and kept them there for about 8-9 years to stimulate the economy. Zero rates. And in Europe, by the way, they had negative rates. Or if you took out a mortgage, the bank would pay you every month. Incredible. But it was true. It lasted for a period of a couple of years. Let's talk about the second power now, a fair and orderly market for U.S. goods. Remember these primary dealers that bid at the opens? And usually they can clear all the inventory and resell the bonds? Well, although the Fed does not directly buy at the government bond auctions, they will and can repurchase unwanted bonds. They can buy them back from the primary dealers. The dealers say, look, we bought $100 of bonds. There's no market for them, and now we can sell maybe 80% of them. And that does happen. It didn't used to happen, but it's happening more and more now in the last decade or two because of all the bonds that are being sold. So when the Fed goes back, the Fed can repurchase unwanted bonds from the primary dealers. The government doesn't want to sell them directly to the Fed because that just looks like the left hand buying from the right hand. So they go through this primary dealer situation. Some people say it's a charade. I don't believe that. But the primary dealers buy them, and then what they don't want to sell or cancel is sell them back to the government. Because the Federal Reserve is part of the government. We'll talk a little more about that. So when the Fed purchases these bonds back, it's called quantitative easing. You probably heard that term. Where the Fed is buying back the bonds, taking them out of the market. And since the Fed is owned by the U.S. government, I say owned, that's a stretch. The Fed doesn't really own the federal government doesn't really own the Fed, but it really is a quasi-governmental agency. So when the Fed buys a bond, the government's basically lending to itself. It's the left hand lending to the right hand. And these bonds go on the balance sheet of the Federal Reserve. This is called monetizing the debt, because really this debt never has to be paid back. So if the government sells bonds, the government turns around and buys their own bonds back, they've created all that money that they spent, and that goes into the economy. But they never have to pay it back, so really that's what's called printing money, or what people refer to as monetizing the debt. is printing money. Money that wasn't there before, nobody owes it. They spend it, it goes into the economy, the velocity of money is how much it changes hands in the economy. And that's how money's created out of thin air. The amount of the government debt that the Federal Reserve has had to repurchase recently is really growing at an alarming rate. Now, during the 2007, the balance sheet, if you want to look at how many bonds the government's had to pay back, look at their balance sheet. Whenever the bank lends you money, it's an asset on the balance sheet. When they buy government bonds back, it's an asset on the Fed's balance sheet. In 2007, it was 0.8 trillion. In 19, at the beginning of the Great Pandemic, it was 4 trillion. And that had to do with the Great Recession and the government buying all those bonds back when rates were 0%. At the end of 2023, it was 8.6 billion. It had more than doubled. I'm saying billion, these were trillions. I'm still using billions for my years working with this. But anyway, the Fed has pared back its repurchases somewhat. Its balance sheet today is down to 8.2, which is a small drop, but not that great yet. Because there's high rates, and rates have gone up dramatically now. There's more appetite for U.S. bonds. The short-term bond, you get for 1 year, you can tie up your money for a year and get 4.7%. It's not bad, based on what rates have been over the last 10 years, which is like 1% or less. So there's more appetite for government bonds now. But as we discussed, the annual budget deficit is projected to be at least 1.3 trillion each year. And if rates do come down, that appetite for bonds may dissipate, and then we're going to have a big problem. So can the Fed continue to print money indefinitely? Maybe just sell the dealers, buy it back, put them on the Fed balance sheet? Can that go on forever? Well, there's this thing called modern monetary theory, and those economists say yes. They say, you know what, the Fed, we don't even need dealers. We don't need people to buy bonds. We'll just sell the bonds to ourselves and make our balance sheet grow. In fact, if you think about that, theoretically, there may be no need for taxation at all. Why tax people if you can just create the money and spend it into the economy? There's really some economists that believe this. But even the NMT crowd acknowledges there are two potential risks. What could make that house crash? The devaluation of the dollar or a crash of the US dollar. That is when foreigners lose faith in the dollar. We understand the Fed's doing this, it's kind of small off, it's through the dealers, it's not really front and center. So right now the foreigners have not lost faith in the US dollar. Recently the dollar's come down a little bit, but it's still just off of all-time highs. So the dollar's still very strong right now, with all the geopolitical uncertainty in the world. So there's the US dollar level, which is so far good, or there's runaway domestic inflation. That's when we lose confidence. Devaluing the dollar is when foreigners lose confidence in the US dollar. Runaway inflation is when us here in the economy lose faith in the US dollar. And we don't have that yet either. Inflation's backed off from its recent highs, so the trend here again is good. So where are we now? I want to go a little bit of history here just for a second. The Great Recession, I mentioned it, 2007 to 9. The aggregate household income, I want to give you an idea of the scale of the spending during the pandemic. Household income dropped back then by $450 billion. The Great Recession blew a hole of $450 billion in the economy. The Fed's monetary response was dropped rates from 5.25 to 0 very quickly because they realized this was a problem. The government's fiscal response was the American Recovery and Reinvestment Act. They injected or created $750 billion to fill that $450 billion hole. The government was already in deficit, so basically the Fed bought all those bonds. That money was just printed. Fast forward to the pandemic. By 2019, the market was doing, the economy was doing better. Rates drifted back up to 2.25 or so, 2.5, and then COVID hit. By the end of 2020, the aggregate household income had dropped by $500 billion in 2 quarters. The bottom fell out of the market completely. $500 billion. The Fed's response was taking that 2.25 down to 0 right away. But what was the federal government fiscal response? Remember, back in 2007, the hole was $450 billion, and they spent $750 billion. Here, the hole was $500 billion, not actually that much larger of a problem. The government went wild. Trump, Biden, here's a total of all the bills. And the total pandemic fiscal stimulus was $7.5 trillion. 10 times the amount spent in PPP loans and extension of unemployment benefits and free money that went directly into people's bank accounts. It used to be trickled down, they'd help businesses and they'd hire more, whatever. This was injection of money right into people's checking and banking accounts to induce spending. And I highlight March 24th to be over the rest of the plan. Economists look back now, I don't want this, there's no politics involved in this. It's not MSNBC versus Fox or Republican, Democrat, whatever. Most economists today look back and say this last $2 trillion was the problem. The economy was already a V-shaped improvement. They didn't need to spend any money or throw money at the economy. They spent another $2 trillion. And that's looked at today in hindsight as being part of the problem. So this was $7.5 trillion of new money created. To put that in perspective, 10 times, in World War II, we spent $340 billion over 5 years to win World War II. Today's dollars, that was $4 trillion. So we spent $4 trillion to win World War II, but we spent almost twice that in that year and a half that we threw at the economy because we were so afraid of a severe downturn. Just astounding numbers. Remember Freeman's too much money chasing too few goods. What was happening with that $7.5 trillion that was sloshing around in the economy at that time? The first 2 quarters of 2020 saw GDP drop an astounding 20%, kind of like the Depression era drops, over 2 quarters. There were far fewer things to buy. Remember the lockdowns and the supply chain disruption and all that? You couldn't buy anything. You couldn't travel because everyone was locked down, but the government's put money in your bank account every week or every month. So you got the perfect storm. The shrinkage was, again, due to lockdown, supply chain, Ukraine war, spiking energy prices, far fewer things to buy. All they have money in your pocket. And what was available to buy was selling at unheard of prices. The real estate index, 45% higher. Manhattan used index almost double. Used Rolex watches, I was looking as a surrogate for luxury goods, up almost 50%. Even though consumer spending has recently cooled on some of this, and then real estate prices haven't dropped yet. The volume of sales has dropped dramatically, but prices haven't responded because sellers aren't coming forward. They've got a 2 or 3 or 4% mortgage. I have a neighbor in Greenwich, Connecticut, that has a 1.9% mortgage, 1.95 I believe it is, from Rocket Mortgage, right at the bottom. Incredible, astounding number for mortgage debt. So even though, but right now, because prices aren't coming down, they're still far above pre-pandemic levels. And what ultimately became of the $7.5 trillion with nothing to spend it on? It went into savings. People just saved it. And everyone in this room, if you think about it, very high-end crowd here. I think that over the pandemic, your financial picture probably was better. Stock market went up. If you own real estate, if you own stocks, your personal savings, you're probably better off than pre-pandemic levels. Not everyone in the economy was as lucky as the people in this room, but that's really what happened to the upper quartile of the economy. Pre-pandemic, there was $300 billion of total savings in the United States, and the savings rate over 20 years has been around 7 to 8%. Mid-pandemic, the $300 billion went to $2.3 trillion. The savings rate became 18% because people, again, didn't have anything to spend it on. They just saved it. Today, it's back down to $1.2 trillion, and the savings rate is actually below the base rate now. People are digging into that savings, and it's running out. This buildup of savings is still propping up the economy, but most economists think that that's going to run out by mid-2023, and that means one of the props under the economy will be gone. We'll have to see how that turns out. This looks like the summer of 23, that savings is going to be basically dissipated. So where are we now? The monetary, Fed, and fiscal government responses to inflation that we have. If we were to grade them, the Fed's monetary response, going into 2022, the Fed believed that inflation was transitory. Janet Yellen, head of the Treasury, Jerome Powell said, well, this is just because of the supply chain disruption. All these prices are going to come back down. So they didn't do anything, but finally, by March of 22 in the spring, they realized that they were wrong. And Jerome Powell came out and said, I was wrong. But you hardly ever hear from anyone in government anywhere. But he understood it. And rates went from 0 to 4.5% over 9 months. Never in history have rates been brought up that far, that fast. So this is brand new stuff. And the Fed has indicated they may go higher. So I give the Fed a great credit. Better late than never. They were late. They realized that they better do something awfully fast, or we're going to have inflation that could run away and destroy the whole economy. What about the government's fiscal response? Horrible. Normally, monetary policy from the Fed and fiscal policy from the government are supposed to work together, hand in hand. The economy is strong. The Fed's supposed to be raising rates, right? And the Fed and the government basically does the opposite with spending. Instead, what happened? Instead of the government cutting down spending, making the Fed not having to buy so many bonds, lower the deficit a little bit, they did the opposite. And they just came out with this $1.7 trillion omnibus spending bill that most senators and the House of Representatives, they didn't even read it. They interviewed these people and said, well, I'm not really sure what's in there. The head of my party says it's good, so we voted yes. Just insane spending. These are basically the budget deficits in 21 through 24 as projected. Numbers that 20 years ago would have sounded just totally implausible. Government could not sustain those kind of deficits, but here we are. So I grade the fiscal response from the government as an F. And again, this is not a Republican versus Democrat thing. It's just not. Politicians spend, and they leave the problem until after the next election. Fed Chairman Powell, and this is really, we're getting to the crux of the matter here now. And I'm actually running out of time. We're getting to the crux of the matter. Powell has said that rates will go as high as they have to and stay there as long as they have to get that inflation number down to 2%. And we are awfully far from that. So if you take it at his word, one way or another, good or bad, inflation is going to be brought down to that level we're close to. I actually take him at his word this time, using his jawbone and whatever, but I take him at his word that he realizes that unless we risk having a 1970s kind of inflation, he's got to do something dramatic. The million-dollar question is, what happens first? Will the rate hikes behind them bring inflation down before causing a huge problem in the economy, a recession or worse? That would be a soft landing. You hear this soft landing all the time. That's if the rates work and inflation comes down before unemployment starts to pick up and people lose their jobs. Or does inflation stay elevated very long and only comes down because a severe recession brings it down? And people don't have money to spend because they're out of work. We don't know yet how this is going to turn out. We just don't know. The answer depends on who you ask. Soft landing, Goldman Sachs, New York should generally avoid recession. JP Morgan, we do not see global economy risk of the first recession. UBS, resilience of the global economy. These are the optimists who say, yep, inflation, the rates are going to work without causing a problem. The hard landing crowd, Fidelity, hard landing looks unavoidable. Recession is all but inevitable. Bank of America, Davis Research, which is an incredibly accurate research firm, we placed the odds at 65% of a severe global downturn, meaning that those rates are going to be sticky. They're not going to come down, and they're going to have to stay very high, which is going to cause a problem. What does history tell us? Well, unfortunately, it's not good news if you look back in time. Over the last 75 years, there have been 6 episodes where CPI exceeded 5%. Our CPI exceeded 9%. Unheard of. This happened it's gone over 5% 6 times. And each one of them, except for one, turned out badly. Where rates had to be raised and the economy suffered, people were thrown out of work, employment spiked. And the only time it did was after the Kuwait invasion. But at that point, Alan Greenspan was chairman of the Fed back then. He started raising rates way before he saw the problem coming. So he acted preemptively, and inflation then had peaked at only 5.5%. But again, we are unfortunately not in that same situation. We're in a far worse situation today. I don't want to sound like gloom and doom, but I try and maintain my clients' expectations, manage them, and give them the straight scoop. And history is not our friend right now. Second, the primary driver of inflation is migrated from goods to services. And services is basically wages. Healthcare, travel agency, stockbroker, whatever. Those are all wage-related and dependent. The labor participation rate has dropped and has not gotten back to pre-recession, pre-pandemic. There's 2.5 million, they call it the 2.5 million missing worker issue. People have left the workforce and they don't know where they are. So you got fewer workers, which is also pushing up wages. And now everyone in this room is, I know there was just an HR session where we're talking about retaining talent, right? How do you retain talent when it's a bidding war now? In our firm, it's a bidding war for good talent. And frankly, I think it's going to be sticky because historically, wage inflation is way stickier than goods inflation. Again, we go back to the die. The first pound or two way easier than the last pound or two. Annual wage growth is now running at 6.5%, very high. Typically, that's in the 3 to 3.5% range. So when you're starting with an extremely tight labor market, right now it's 3.5%, which is basically that inflation rate is embedded in the economy and can't go much lower. Rising wages are a double-edged sword. It's good for workers in the short term, they're making more money. But it's bad in the long term because it creates more inflationary pressure that ultimately has to be dissipated one way or another. The final thing is this thing called the yield curve. This is kind of like one of those esoteric economic things that I like to talk about. It's an inverted yield curve. Whenever you see an inverted yield curve, this is the most accurate, deadly accurate indicator ever for recessions. It's predicted 6 out of the last 6 recessions. Right now, the yield curve is inverted more than it has ever been in history. Normally, interest rates, the longer the term, the higher the rate. When you take out a 30-year mortgage, that rate's higher than a 15-year mortgage. It's higher than a 5-year mortgage. But right now, short-term rates are actually higher. You can get, I mentioned before, 4.7% on a 1-year government bond. You can borrow 30-year money for 3.5%. You're saying, why? How can that be? The reason short-term rates are higher is because the Fed controls those short-term rates, and the market controls the long-term rates. So as the Fed is ramming interest rates higher in the short term, everyone's anticipating a recession or a downturn in the longer term. So the market's bidding those prices down while the Fed's driving the near-term rates up, and that's caused it to invert. And that's again, as I said before, it's a bad indicator, bad omen. That's a lot of negative news, but there's good news too. Right now, the economy, if you take a snapshot, is very strong. If you look at the economic metrics right now, fourth quarter GDP just came out literally a day or two ago at 2.9%. That's a very positive number. It's a strong number. Came down from 3.2 the prior quarter. Unemployment rate is 3.5%, as we talked about. Household net worth, as we mentioned, is very high right now, so there's a cushion there. Housing prices are firm. And corporate profits and stocks are off somewhat from their high, depending on the NASDAQ is off 20%, but it's rallied 10% since the beginning of the year. So stocks and equities are down from their highs, but not that much yet. So this strength in the economy, coupled with inflation rates starting to trend down, is good news. That means that the Fed is winning right now. Right now, things are starting to point to soft landing, but we're not sure. So, soft landing. Inflation subsides. What should an investor do right now? If you've got money in your brokerage account or whatever, what should you be doing with it? Well, it depends. It's like what I talked about. Are you a soft landing optimist or you're a hard landing pessimist? If you're a soft landing, overall asset price classes will fall marginally, but then they'll resume their upward trajectory, right? So you can't pick the bottom. But if you really believe we have a soft landing, you want to be an investor here now. You want to be buying things. Real estate, low mortgage rates will put a floor under prices and buyers will return as those mortgage rates come down. Lower rates raise PE multiples in the stock market and they will recover back to the old highs. Cash, you don't want to hold it. because you're going to lose money vis-a-vis real economics by holding money. And if it is a soft landing, the first half of the economy will be weaker than the second half. We'll have strength going into the second half of the year. So you probably still have some time before you commit capital. If you believe in a hard landing, that means the economy buckles before inflation. That means a recession or a mild recession or a severe recession. Asset prices will probably still move lower from here. Mortgage rates are going to remain high, and housing prices will catch up with falling sales. And you'll see a downward bias in housing prices. Stock markets earnings will shrink, and the market averages will reach new lows. They haven't seen the low yet if we have a hard landing. Maybe far from. Cash will be king. It will outperform all asset classes. Just getting 100% of your money back by the end of the year, unless you invest in the bond market. So it really depends on, the information I've given you today to make your own decision on where you think the economy is going. If you ask 20 different people like me, you'll get 20 different answers. But you're all smart enough to make your own decisions. The big problem here is what's stagflation. Usually high inflation and high unemployment do not coexist because the things that generate one are basically mitigate the other. But in a situation where interest rates stay high and the economy is weak, you can have high inflation and high unemployment rate, which is devastating to the working people in the economy. The ACEC industry. Do I have 5 minutes? Not sure I do. John? I've run out of time here. For the ACEC, I will say one thing. The main driver of your profits this year, because there's a lot of things that affect your profits as a company. This particular year, economy is going to have an outsized effect on what you do every day and how you make money. Right? So, and that's probably the biggest question mark we have right now. What we have seen, and I think some of my people, I'm not an architect or an engineer, it's not my thing, but I've been given some information from the people that work in this every day. They say inflation is continuing to drive costs and projects higher. Backlogs are still at record highs, but I guess there's the Architectural Billings Index, which was recently dropped below 50 as of the end of last year. So that means there's a contraction overall in spending. But the positive news is that there are still 2 huge federal bills where the money is just starting to come into the economy. The infrastructure spending, right? There's usually a 6-month to 18-month time lag. We're just over a year now, so I think the economy and your industry is going to start to see some of this federal money filtering through. It also pushes M&A. Because the private equity firms, they want a piece of this, the government money that's coming into the industry. M&A activity reached an all-time high in 22, 500 plus deals. Private equity liquidity continues to drive there's an ocean of money out there looking for return. The private equity funds are flush with cash, looking for operating businesses that generate profit. Interstate deal activity, all-time high, Texas, Florida, the usual suspects, where a project is looking for funding, and deal multiples continue to rise. I'm told Sullivan, that's 7 to 9 times EBITDA, is now giving way to 10 plus EBITDA values for businesses in your industry. Overall now, there's a wide range within that average, but overall, if you're a top firm in one of those areas that we talked about, one of those states with the right with the right aspects to your business, you can expect to over 10 EBITDA. The word about taxes, this is tax gobbledygook that I speak every day. The Indian industry is still waiting for Section 174 requirement. Our people think that it was in the omnibus bill originally, and it was pulled out at the very last minute. It was traded for some kind of child care thing at the very last minute. But it will be introduced, and our people and our firm believe in the industry here that this will eventually happen. Correcting this 174 requirement to amortize R&D. The Section 179D benefits that are now applicable to not-for-profit projects, and we expect IRS guidance this year to provide clarity in this, because a lot of people don't know how to apply all this yet. So eventually that will hopefully be rectified. That's it. I thank you all very much for listening. Thank you.
Well, what I want to ask is, I can't take up this opportunity. I hope I'm not stopping the schedule, but are there any questions? My last one on that slide was, you have 179D and R&D. This industry is out $500 million on PPP retention job credits. We'd like to get that in there too. But are there any questions for Tom? That was just a phenomenal, if that's okay, Tom.
It's okay.
All right.
You got
question
time,
right here.
I got whatever.
Economics, side of the interest rates. Are there things that you do to magically bottleneck the economy or to expand the labor force? That's my question.
So if it's a labor question, the answer is, where are these 2.5 million people, right? That's the first thing. The labor participation rate is down. If you look at, I believe that it's from 20 to 55 is that fat area of the snake for everybody that works. That has shrunk. And economists are at a loss, right? They don't, usually that comes back with the economy. I think one of the problems is that a lot of the bottlenecks are global, macro, not so much within the US, right? So the Ukraine war, the chip situation coming out of Asia, those things we have some control over, but not that much control over. If you ask a worker, he says pay me more, or she says pay me more. I'll gladly work for 1.5 to 25% more than I was earning before. That's the easy answer. But that's not good for profits, and eventually that's not good for the worker. It's hard to convince workers about that, but it's really the way it works. So, to answer your question, I think that some of this we don't have control over. I think higher wages is a very short-term solution that may come back to haunt businesses, at least in our shop. We're paying people more than, we're making partners quicker, we're paying them more to start as partners, we're paying them way more out of school. I have a relative that just graduated from one of the top law firms in the country, starting out at $240,000 a year out of law school. The wage scale is just driven astronomically higher. And again, I believe personally, yes, 5 different people, you get 5 different answers. I think that we're going to have, in hindsight, we're going to think, what were we thinking? Right? And then there'll have to be an adjustment as that happens. Well, I think that's the best way I can answer that question.
Very good. One more.
Sure, go ahead. No, on the contrary, the question is, do Americans see themselves as a victim of all this money that was spent? Well, in the long run, that may turn out to be true, but in the short run, it was like Abu Dhabi, right? Everyone is better off before than they were after. So if you have somebody and you want to pay for the money in your bank account or not, who's going to say no? But I think in the long term, this will hurt the economy because eventually this excess has to be run out of the system somehow. And I don't believe that can be done completely painlessly.
Thank you very much. Let's have another round of applause. Very insightful.